I want to go back to that SocGen note for a minute. Critical juncture, that's what they're calling the S&P, or what they're saying the S&P is at right now. Do you believe that we're at a critical juncture? Are you concerned we might be in bubble territory or just on the path for some wild volatility? In their mind, it could go from, the 4,000s to 6,600.
I don't. If you look at what the market and financial assets respond to, it's really liquidity. And is the Fed increasing liquidity in the balance sheet or not? The SCBO just came out with a budget forecast at $1.6 trillion. Then they revised it back in June, saying it's going to be $1.9 trillion. That's because of mandatory expenses and net interest. That's going to continue to grow. And the Fed has to monetize the debt. And by that, I mean the Fed's going to create money out of thin air, buy bonds from the balance sheets of the banks and individuals, and then put that on their balance sheet. So the balance sheet has gone from $1 trillion to $7.5 trillion since 2008, and financial assets respond favorably to increasing liquidity. And so I don't think that dynamic is going to change at all.
Understood. We're going to talk a bit more about the Fed in a second, but I just want to focus on the markets now for a minute. We're hearing a lot of talk about, the trade moving from AI and kind of broadening out to things like cyclicals right now, with the thought that we are going to get that rate cut later. Are you also advising your clients to do the same, to basically spread out their investments, to move just a bit away from this tech trade that's really been working all year long?
No, I'm actually going to overweight tech because if again, the reason I mentioned liquidity is that technology actually is very correlated to the increase in the liquidity. And I think we're going to get a rate cut. I think we'll get one rate cut. CPI, based on the base effects, is going to look good in August, right? You've had car prices year over year go down about 9%, rent and shelter is sort of, moderated. That'll reaccelerate at the second half of the year, particularly in the beginning of next year, when shipping costs, there's like an 18-month or 1-year lag. So I think we'll get a re-acceleration of inflation towards the back half of the year and the beginning of next year. We'll get one rate cut. Okay. But I think the reason that tech will do well is because they're going to have to expand the balance sheet so we can continue to monetize the debt.
All right, Ivory Johnson saying you're overweight on tech. Stick right there right now. I want to pivot over to something. We have some exclusive data that we want to get your reaction to. So we're looking right now at CNBC's second quarter CFO Council survey, where we get insight on the market, the economy, and much more from decision makers at the world's biggest companies. So the Fed, it remains top of mind, especially that much anticipated cut from the Federal Reserve. 38% of global CFOs expected to come in September. Roughly 17% believe that cuts will come after the election, either in November or December. And it's important to note that more than a quarter of global CFOs believe we will not get a rate cut this year. This quarter survey was taken between June the 3rd and June the 20th. During that time, we had a Fed meeting where rates went unchanged, but outlook signaled fewer cuts. We also got a much better than expected CPI report. We also saw the S&P 500 top 5,500 for the first time ever. It was in this environment that CFOs gave the Fed high marks on its battle against inflation. 71% saying the central bank is doing a good job. That's the most in one of our surveys since Q1 of 2023. 4% also saying the Fed is doing an excellent job. But still, CFOs had some concerns about when inflation will hit that 2% target. 29% say it's going to happen in the first half of next year. A quarter say in the back half of 2025. But you look here, look at the bar chart. 42% said it would take until 2026 or possibly even later to get back to 2%. Those inflation concerns are closely tied to recession concerns. More than 40% of CFOs believe we will see a recession in 2025. More than a quarter believe it will come in the first half of the year. But still, we have a third that are optimistic. A third are confident that we are on the path for a soft landing. All right, Ivory, I want to come back to you right now. You already kind of gave us your take on this, but I do want to get a very clear take from you on your rate cut expectations. Do you believe that September is in play? Again, more than a third of those global CFOs believe we will see a cut in September.
I do, because the August print, if you look at the base effects, you're going to compare, 3.25%-ish with 3.7%-ish the year before, 8% 2 years ago. So it's going to look dovish. And it's going to happen right before the Fed's meeting, the FOMC meeting in September, or at least by November. So I think the rate cut comes in September, but I think there's going to be a reacceleration. Remember, energy is still in a bullish trend. There are a lot of other components that haven't gone up as much as we thought they will. And then even if you look at growth, real growth GDP has been shallow. And so yeah, I agree with the CFOs who think that we're going to get more inflation, and we'll get one rate cut. Whether or not we get a recession, it's too soon to know. But what drives GDP is worker productivity, demographics, and government debt. And what we saw last year is anytime those two factors decline, as they have been, the government steps in. So we had an industrial recession last year. We had a corporate profits recession. We had a manufacturing recession. But government spending came in and picked up the slack. And I would imagine that's what's going to continue to happen.